In this video, I want to walk through the differences between using a plant-wide predetermined overhead rate to allocate manufacturing overhead and a departmental predetermined overhead rate. You'll remember from the comprehensive example video, which I hope you've looked at. I think it makes more sense to look at it before this video. But you'll remember that what we're doing with the predetermined overhead rate is coming up with a rational, systematic way to take our indirect manufacturing overhead and allocate them to the jobs, given the fact that while the manufacturing overhead is incurred in order to perform the job, there is not a direct relationship that allows for tracing the cost directly to a particular job. So you'll remember in that example, what we did was we took all of our overhead costs, we lumped them into one pool and said, we're going to allocate all of these overhead costs based on, I think it was direct labor costs, but whatever we've identified as the appropriate allocation base, direct labor costs, direct labor hours, machine hours, whatever we think is the best cause and effect reflection of the costs. So we took all of those costs, divided them by our estimated direct labor costs, and then allocated the resulting amount. That was appropriate in a situation where we believe that all of our overhead costs are incurred based on a similar allocation base. In some instances, particularly in instances where we may have different departments performing different functions, it may be that it is more appropriate in one department for direct labor hours to be the cost driver or the allocation base, whereas maybe in another department, machine hours is best reflective of the incurrence of the cost. In those instances, it may make more sense to break our overhead costs into multiple pools using different allocation bases and have more than one allocation of manufacturing overhead. That's the background. This example that I'm going to walk us through is reflective of that. So the data we're going to work with, we have budgeted data for this company. There are two departments involved in the manufacturing process, the machining department and the assembly department. We have manufacturing overhead for both. Here is $500,000 in the machining department, $100,000 in the assembly department, for a total of $600,000. Then we have identified for both departments and in total the number of direct labor hours and the number of machine hours. And then we've got two jobs that we need to allocate overhead for. And so for each of these jobs, we've identified the direct labor hours that have been incurred on the job and the machine hours. Here's job A and then job B. Okay, if we're using a plant-wide predetermined overhead rate, then we're going to take the grand total of the $600,000 in overhead and divide it by our allocation base. In this example, I've assumed that our allocation base is direct labor hours. So in this cell, I've taken the $600,000 in total manufacturing overhead, divided it by the $60,000 total direct labor hours, and have come up with a predetermined overhead rate of $10 per direct labor hour. Then for each job, job A, I took the total direct labor hours of 15, multiplied it by that $10 predetermined overhead rate, and came up with $150 in manufacturing overhead to be applied to job A. In job B, I've taken the $10 direct predetermined overhead rate, multiplied it by the 9 direct labor hours incurred in job B, and came up with $90 in allocated overhead rate. Okay, so that's the same procedure that we did in the other example. Now, let's say instead that we believe in the machining department, machine hours are a better cost driver allocation base for manufacturing overhead, because most likely, if we're in the machining department, the majority of the manufacturing overhead is related to the operation of the machines. On the other hand, in the assembly department, we have determined that direct labor hours are a better allocation base. Again, we've looked logically at what those manufacturing overhead costs are and assumed that they're more closely tied to direct labor. So what we're going to do is we're going to calculate 2 different overhead rates. For the machining department, we will take the total manufacturing overhead in the machining department of $500,000 and divide it by the 50,000 machine hours. And that gives us a predetermined overhead rate for the machining department of $10. Then for the assembly department, we're going to take the $100,000 in manufacturing overhead incurred by the assembly department, divide it by the 50,000 direct labor hours that were incurred in the assembly department, and we come up with an allocation, a predetermined overhead rate of $2. Then to calculate each job, we'll have to do 2 different calculations, one for the machining department and one for the assembly department. So for the machining department, job A, we're going to take the $10 predetermined overhead rate, multiply it by the 11 machine hours incurred on job A. Then we'll go to the assembly department, take the $2 predetermined overhead rate, multiply it by the 10 direct labor hours incurred on job A, come up with $20 for a grand total of manufacturing overhead applied of $130. Job B will go through the same process. We'll take in the machining department, we will take the $10 and multiply it by the 12 machine hours incurred on job B, come up with 120. And then in the assembly, we will take the $2 predetermined overhead rate, multiply it by the 5 direct labor hours incurred in job B, come up with $10, a total of $130. So notice what's happening. When we used a plant-wide predetermined overhead rate, job A got a heftier allocation of overhead than job B did, $60 more. In reality, when we look at the amount of effort incurred in each department, they really should have gotten an equal amount of overhead, which means if we used a plant-wide predetermined overhead rate, we could easily end up overcosting one job, undercosting the other. And if our price is based on that cost, we're going to end up overcharging one job and undercharging for another job. And that is going to impact our profit based on maybe over or underpricing, and we may lose business if we're overpricing a job. So that if indeed your overhead costs are incurred based on different cost drivers, and it is feasible to divide those overhead costs into smaller pools, you will most likely get a better representation of the costs of your jobs.